Welcome back. This is Chart Overload. I'm Ryan Mumy, the CEO of Sollinda Capital Management. That's Justin Greenhill, our Chief Investment Officer. Justin, are you ready to do another episode of Chart Overload?
Born ready, Ryan.
Yeah, born ready from Brazil. By the way,
From
Justin,
Brazil.
we're recording this while Justin is in Brazil on the ground, learning all about the Brazilian economy and enjoying not the rainy weather like we have here in
Not true. It's actually
North
pouring
Carolina.
rain here today.
No, it wasn't earlier. That's good.
Or as they say here, tá chovendo muito.
That's good. But anyways, let's get cracking with Chart Overload first. The big picture. First chart, our old friend inflation. The producer price index on the left, the core PPI on the right, headline and core. And what we see here is a rising line, which in this instance is not good.
And we'll get to this, but the stock market at least, tends to disagree with it being not good. But in general,
for spending,
for spending, right? So a couple things really stand out here. First one is, despite this pickup, we're still way off what were the highs of a few years ago on a rate of change basis. But perhaps maybe even more interestingly, if you look at the one on the right and you take out energy, which is, oftentimes the most volatile input, you're still seeing a move higher, which just goes to show that this recent supply shock caused by energy is feeding its way through to other inputs.
Yeah, I mean, inflation is good oftentimes for the stock market, but it puts immense pressure on consumer prices. Obviously, the same amount of money doesn't go as far to buy the same amount of goods and services, and it ultimately will put pressure on corporate margins as well. So, but initially, to Justin's point, oftentimes the stock market can react favorably to this. Next chart looks at average hourly earnings. And what we see relative to CPI or inflation, consumer price index, and what we see here is wages are no longer outpacing inflation.
Yeah. So this chart really kind of says a lot in that it basically says that on a real inflation adjusted basis, wages are dropping off here because inflation has gone up. But we must emphasize that when you look at something like that, you have to also consider that when they average wages, that's a huge spectrum. So back to our whole thing we talk about, it seems like every video of the K-shaped economy, there's a certain segment of the population that although their wages are decreasing by inflation, it's far less noticeable than it would be for other segments of the population. So take this chart with a bit of a grain of salt, but in aggregate, on average, it kind of paints a good picture of what's been happening.
You know what's not shrinking, moving on to our next chart, is the spending going towards AI demand. I mean, I feel like we show this every one of these videos, and the bar charts just keep getting bigger and the numbers bigger. Just show it, and it said the numbers have gotten bigger.
Yeah, a couple points. We might want to clarify the words and say that this isn't necessarily AI demand. This is spending in expectation of what will be future AI demand, right? So
Yep.
say it differently. Let's say this is demand by the biggest of big companies to spend as much money as they can to kind of solidify their position in the marketplace. So as you see here, 2026 is a huge year, but I mean, that's expected to increase even more next year. And as we've mentioned a couple other times, notably last year, this CapEx spending actually did more to domestic GDP than the entire aggregate consumer in the United States, which is, I mean, that can't be overstated in terms of how significant that is when you consider consumption is the vast majority of the U.S. economy.
And has been for its history. We talked about it last year. It was the first time ever that this type of corporate spending outpaced the consumer as a whole. But it's almost like I've heard it described, it's almost like it's turned into a spending arms race. Like who can say the biggest number? Because, investors by and large haven't really been punishing companies for this, maybe temporarily, but share prices have by and large rebounded.
That's a good point. Just to add to that, in order to see that, you'd have to really look on a relative basis. Like, for example, Google has been rewarded more so than, say, Meta or Microsoft. And that's perhaps a function of the market currently believes that Google is closer to monetizing and profiting from that spending versus there's a bigger question mark for some of the other ones.
Next chart takes a look at the spot price of some of the components that go into the chips that everybody's after for again the AI capex, the build out that we discussed in the last chart. And I mean, this just shows the demand is stronger than the supply.
Yeah, so this is so-called DRAM, which is basically the chip that does, different types of memory. And up until this most recent cycle, as you can see by the chart here, this was very much the commodity chip in the sense of it was very relatively unspecialized and would often trade in it'd be undersupplied and then oversupplied. But because of AI, and in particular because of the need to do inference and training of all these various models, you've seen demand dramatically outpace supply. And there have been, several companies that have benefited from this, but from a geographic standpoint, this is what's driven the Korean stock market pretty strongly, which we've talked about in prior videos. So eventually, one would expect supply to meet demand, but as seen in this chart, it hasn't happened yet.
Yeah, hasn't happened yet. Next chart looks at China. Their percentage of exports relating to six key aspects of, I guess, the industrial products, and by and large, they've been taking some market share.
Yeah, so we thought this was timely considering we just had the President Trump meeting with Xi Jinping in China, and this just basically shows that, despite tariffs, despite what, on a headline level has been pretty negative for what you would think the Chinese economy is experiencing, on a global basis, they continue to take market share. And where they may have not done that within the US, if you look globally, they've certainly done that.
Oh, and look at this next chart. I mean, it looks at the volume of exports on high tech and strategic heavy manufacturing equipment. I mean, this chart is only showing 6 years, and these are massive increases.
And this chart is in particular, so as these lines go up in these different categories, this is China taking market share on a percentage basis from Germany in particular. So you think of Germany doing all these, relatively high-end manufacturing equipment, machines, cars, trains, etc. Well, China, as seen here, is just taking their market share at an unbelievable pace. And you mentioned here about Brazil. You look around and there's just nothing but Chinese cars. And, a few years ago, there were none. So you've got that. And a lot of that, although it does take away from, Japan, et cetera, Germany is a huge car export, amongst other things, in terms of machinery and things like that. So China is basically cannibalizing German market share at a unprecedented pace.
There's that word again, unprecedented. Next chart takes a look at U.S. financial conditions. And again, we're talking about inflation. We're going to talk about later about interest rates, but there's lots of concern out there. But despite all of that, financial conditions remain pretty loose, meaning the access to credit, to liquidity is solid.
Yeah. And you got a few key things that are kind of keeping this subdued. One is obviously the fact that even though the expectations for interest rates have changed a bit, and we'll talk about that in the next section, another one is just the fact that interest rates, despite the expectation changing, they've not gone up, which would tighten financial conditions tremendously, or at least they've not gone up from a policy rate standpoint. And then at the same time, there's kind of like a circular feedback loop that if the stock market is strong, if volatility in the stock market is relatively low, and to your point, if the credit market stays, so-called tight, then that actually makes financial conditions loose. That's where we are, and what happens from here is to be determined. But it wouldn't be accurate to say that financial conditions are tight, I think, is the only clear takeaway.
Yep. Moving on to our next section, looking at domestic stocks. First chart looks at earnings, and as we talked about the last video, the earnings have been remarkable. This shows it's their best non-crisis time frame, or recovery from a crisis time frame. It's the best earnings in a couple decades.
Which is pretty unique, right? I mean, if one would have sort of looked at how the economy was last year, you would think that there's going to be higher expectations and thus it'd be somewhat harder to beat. But it's actually been the opposite. Not only was it the biggest of big companies that kind of blew it out of the water, but just S&P 500 companies in general had an extremely strong earnings season, which I think, as you said in our last video, Ryan, despite what might be a little bit of near-term volatility, that puts a very positive backdrop onto the stock market, which ultimately makes it harder for, big pockets of money to be sustainable sellers if there is that in the background.
It's easier to run with the wind than against it, as the saying goes. But yeah, it kind of defies what some were talking last year. We're in late economic cycle. Things should slow down. Well, this latest earnings says try again next time. Hold my beer. Next chart looks at the performance of chip companies um, relative to hyperscalers, the companies spending the money on building out that we showed a few charts ago, and the actual semiconductor companies are blowing those out of the water.
Yeah, one way to look at this is, if you look at the companies that represent the underperforming blue line, they are buying the semiconductor chips from
Right.
the outperforming black line,
Yeah.
right? So, and you talk about NVIDIA, I forget the exact number, but a huge percentage of their revenue is coming from a handful of companies. So those companies that we mentioned earlier that are doing AI CapEx, a big part of that CapEx is buying chips from these
What was
companies.
their latest quarterly earnings? They made 80 billion in one quarter or something like that.
Yeah, what's fascinating is they've got so much money, NVIDIA, that they're able to pursue growth. They're able to buy all these other companies that are within the AI ecosystem. But at the same time, what was pretty much lost in the reporting was they're actually also doing a share buyback program. So, money to spare.
Money to spare. Next chart again, semiconductors looks at their valuations, and they are in historically overheating. The ratio is showing that it's overheated. But I guess the counter to this, is it overheated? Are the valuations stretched, or is the market front running what will be really strong earnings growth like we saw from Nvidia this week?
Yeah, anytime a market starts to kind of trade at a higher multiple, like we're seeing here in this chart, there's, all sorts of stories to explain and justify that. And to your point, this is obviously very forward looking. And one of those narratives would be the fact that, AI build out, or just the whole race for AI, what do they call it? General intelligence is a national security priority, right? So in addition to the private sector going and doing that, you've got the government doing it. You've got the government feeling like they need to race against China. And ultimately, the end result is that the market is giving semiconductor companies a much higher valuation than they have historically gotten, albeit it is below the highs of a couple years ago, which just shows that real earnings have started to manifest.
Next chart looks at S&P 500 market breadth, looking at the average performance within a standard deviation, and what we see is what we've talked about. Very few companies are driving most of the returns of the S&P 500.
Yeah, and, this is something that's been kinda going on for quite a number of years now, and even though we'll see periods of time like we saw from roughly October, November to into March where, the broader market outside of the biggest of big companies does start to kinda outperform, it always shifts right back to where the biggest of big companies continue to outperform, and with this most recent rally in the stock market over the last couple months, we're now back to, once again, being able to say that few companies are responsible for the vast majority of year-to-date returns within the stock market, and this pretty much expresses that.
Last chart in domestic stocks looks at systematic positioning. Again, these big, massive pots of money that are pretty indiscriminate in when they buy or sell, solely based on some signals. And what we see here is they're kind of in the middle. There's not really extreme conviction either way.
Yeah, it's important to put this into context. So, there's a lot of different ways that one could kind of tally this up. This is a company called Tier 1 Alpha that was one of the first ones to do it. So, take the actual number that you hear with this with a bit of a grain of salt, but the importance is kind of like where it's come from. So, as you see here, systematic strategies, whether they be price focused or volatility focused, were at the lower end of their bound. And then on this most recent rebound, they've shot up pretty quickly. And if you look back several years, you'll see that, we are still well below what were the highs of several years ago. But it's important to remember that those moments are moments with much less volatility. So if volatility in the stock market were to progressively fall from here, which it very well might into the summertime, you could see a situation where this line could grind itself higher.
Moving on to interest rates. First chart looks at expected Federal Reserve policy. There was a lot of pricing in rate cuts, and now that's kind of turned over.
Yeah, so this is a pretty interesting chart. You see the blue line that's moving lower. That was the expectations for rates before the conflict in Iran kicked off, and then the other two lines are basically the re-rating of, now expectation is not only to maybe keep rates high or keep rates where they are, but there's actually a possibility that the Fed may have to hike rates. Now, if listen to the recent this week's testimony of incoming Fed Chair Warsh, he kind of poured some cold water on the rate hike aspect of it. Basically phrasing it in such a way that if this situation continues and inflation moves higher, his wording was that that would justify keeping rates where they are longer. So, despite what the market's pricing here, the Fed has yet to even remotely communicate rate hikes as a possibility. And
Correct.
assuming they do, we think that could really lead to a pretty significant and quick re-rating in the market.
And that's been a hot topic, right? In the what I call the macro thinking community. They're not usually actually managing money. They just talk about economic policy. Was how Warsh is less interested in as much transparency as there has been really since Ben Bernanke. And the Fed has oftentimes followed the market participants' expectations, and there's talk that might necessarily be the case because of a less transparent Fed. But again, we'll see. To Justin's point, we don't know. Nobody's said anything, but that this is where the market's pricing it now. So it's something to pay attention to, because back to a few charts ago, financial conditions, as Justin said, is if the Fed does hike, that changes that dynamic quickly, and it sucks some liquidity out of the market.
Well, not
Which
only
tends
if
to
they hike, if yeah, that's a great point. If they actually start even communicating that they view
correct.
it as a possibility, that's a big difference. And that's not what we've seen so far. So, I mean, that probably is a risk potentially, but at the same time, again, there's no indication of that. And as you just said, the fact that the Fed now might start to adjust a bit of their communication, and the critique for that is people have argued, and this is one of the arguments of Secretary of Treasury Bessent, is the fact that the Fed has been so communicative in their forecasting, which often is not that accurate. They've been then just forced to kind of chase market expectations.
Yep.
Versus if you go back to the Greenspan era, market participants were really kind of left guessing all the way up until each and every Fed meeting.
I remember they would show on CNBC, the thickness of Greenspan's briefcase heading into meetings because they had no idea.
Right.
Moving on to the next chart, looks at yields from the UK, the US, and Japan, and relative to the Iranian war, which is the gray box on the far right. Yields have risen.
They have risen. So, we just spoke about kind of what the market's expectations are for policy rates. We're looking here globally at the long end of the yield curve. So, this is the market's expectation of central bank credibility, inflation expectations, so-called term premium. And for a variety of different reasons, this has been in an up move for a few years now. And where that stops, we will have to see. But one would think at some point, if this continues, that does start to create some volatility across asset classes, but it hasn't yet. And another key point to think from this is historically, there's been sort of a balancing off between exposure to stocks and bonds. And progressively over the last several years, if that mechanism is still in place, bonds, especially duration, are now very underowned relative to stocks. So it's not at all within the market price signal, but if the economy were to suddenly slow and the stock market were kind of caught off guard as that, there could be a lot of money very quickly rush back into the bond market. Not too dissimilar to what we saw when Silicon Valley Bank failed at the beginning of 2023. It was like overnight
Yeah,
yields were
massive.
massive. Yeah.
Yeah. Uh,
So we'll
Next chart looks just at that, at volatility. This is the The move index is in white, which tracks the volatility of the treasury market, and the blue line is the VIX, which tracks the volatility of the S&P 500. And what you see here is there's been a lot of an uptick in volatility in the move index and interest rates in the bond market, and equities are calm. It's a very differing stories, if you will, that this piece of data is telling.
Yeah, equities are relatively calm, but having said that too, bond market volatility is still very much off the highs of where it was back in March. So there's not really too much to see there. And whether or not these two actually one leads the other is there's no real evidence on that, but we'll see where it goes. It's an interesting time in that the bond market seems to, at least for now, be driving what happens in the stock market less than what historical examples would imply that it could.
Could this be another breakdown of historical relationships? If we've highlighted several over the last year plus that
And
at
yeah.
some point maybe they come back together, but there could be a dislocation for longer than has historically happened, just as the market, the backdrop are much different inputs.
Well, and then one could maybe try to explain this with some narrative of just saying back to the AI CapEx chart, there's so much capital expenditure that could go into higher earnings, could go into higher productivity. That's sort of driving long end rates up. But over the longer period of time, that may not necessarily be negative. It could be positive for earnings. And we might be in a, to use a Fed term, we might be in a new R squared environment where the natural rate of interest is higher than it was in previous years, to be determined.
Next chart looks at the difference between CPI, the government's inflation data for the consumer, and then the trueflation measure of U.S. inflation. And what we see here is quite a difference. There's a gap there.
Yeah, this is interesting. So, trueflation, by pretty much anyone's thought or analysis, would be that it is a much more robust, accurate, nuanced way of tracking inflation across various different parts of the economy versus CPI is a more limited and perhaps outdated way of doing it. But nonetheless, the market listens to CPI. And at the moment, CPI, we're basically seeing some stickiness in services. We're seeing the input of inflation from oil, and we're really not seeing nearly as much of a pickup from trueflation. So, if one were to maybe make a bullish case for bonds here, saying that this rise in rates is going to be short lived and we're soon to see the market shift and think that inflation is now going to be priced lower and rates come lower, this could add some conviction to that. But again, we see no sign of that in market price action yet, right? The price action says rates higher, inflation going up.
Moving over to the tour, what's happening outside of the U.S. First chart looks at current President Lula in Brazil. Was in a neck and neck race with Mr. Bolsonaro, and Bolsonaro fell off a cliff because of some. Justin was telling me because of some scandals going on, and now Lula is strongly in the lead.
This is a
Flavio, yeah,
this is Bolsonaro Jr., the
yep.
son, in prison, Bolsonaro Sr. What's interesting about this chart is Bolsonaro Jr., Flavio, was not even believed to be a candidate until the very end of last year. And then they reported it as he received a handwritten letter of endorsement from his father and then basically kind of took over the position, which at first was viewed as a negative for the market, the Brazilian market, and then soon after became a positive. As you see here, he kind of rose up in the polls, which he's the blue line. What happened here recently was some members from the left party were involved in what is a big banking scandal of this guy who basically crashed a bank and had to get a government bailout, was associated with politicians on the left. Bolsonaro Jr., Flavio, actually went to a campaign rally wearing a t shirt trying to pin this guy with the left, only to then some days later a audio get leaked where he was visiting that individual on house arrest asking for money to do a documentary about his father. But with that being said, relative to history, the market here in Brazil does seem to be kind of ignoring a lot of those politics. And the reason for that is although the right is typically more friendly for markets, Lula is a known phenomenon now on the left, having been president many times over for a long time. And I think by and large, investors just are kind of looking through that, in general. And that will take us to the next chart.
Yeah, the next chart looks at the U.S. dollar relative to the Brazilian real, the currency, and we've got. I hope we have graphics for this from the marketing team when Justin brings out his art skills, but they're on full display here, showing some spikes in the U.S. dollar strength relative to the BRL, which has just happened here recently.
So the first orange circle or yellow circle, highlighted circle there is basically when it was announced that Flavio was going to run. The initial response was that that was not a good thing because it would mean Lula would win. That volatility proved short-lived. Dollar declined pretty substantially versus the BRL. We ran into another moment of global volatility you see there in March. And then most recently on the far right, we've had a bit of a pickup in the dollar based on what you just described, these headlines around Flavio Bolsonaro, but also the fact that there's been, a little bit more risk off too, associated with this pickup in inflation. So net net, you can kind of see there is very clearly a downtrend here in dollar BRL, and a lot of that has to do with inflows into Brazilian equities on cheap valuations, but perhaps even more so the fact that real interest rates in Brazil are historically high on an absolute and relative basis to the US.
Moving on to commodities, first chart goes back to 1986 and looks at the price signal over a year, the price range of crude oil, and I mean, as you see here from the one color line for this year, it's pretty historic. The year to date change in the price of oil.
Yeah, this chart, it's really interesting. Anytime you look at these charts that show this many years of any sort of asset class, if you look at stocks, for example, you're going to see much more similarity between all years because, stocks often do drift up over time and have somewhat of a predictable seasonality. As you can see here with oil, if you just roll the dice on any given year, it could basically go in any given direction.
Yeah.
It just so happens that this year is going to be one for the record books in terms of how quick and sharp the rise in oil has been over what has been less than half a year of trading.
And we see that with the higher inflation data. And again, as we've talked about, there's not been a ton of signal from this because the markets have continued to go up. Outside of yields are continuing to rise, but as we said, that hasn't spilled over yet. So again, it's something we're watching. It's something to pay attention to. And if they stay elevated, the question is, when will all the other asset classes outside of bonds wake up and some volatility returns? And the counter to that is maybe it doesn't.
You bring up a good point, right? If one were to look at this line and see how different that is than pretty much all other years in terms of the magnitude of an oil spike, you would think that it had, impacted and still was impacting more asset classes. But outside of the bond market and expectations of interest rates, I mean, it's just been a blip so far.
Yep. Which goes back to last time we talked about how wage growth relative to the last time oil was trading at this level, it actually impact on the consumer is much less. It would have to go higher from here to have that same percentage impact on disposable income. But again, had you shown us this chart 2 years ago, we would have thought the S&P would be down 30%. And
That's a good point. If you remember back to when there was the last kind of commodity bull market right after the global financial crisis, when they were talking about peak oil and all these other these narratives. Back then, the closing of the Strait of Hormuz would have been considered like the most catastrophic,
yeah.
destructive that could happen. And then here we are, global stock markets at all-time highs. So it's
Yeah, and people have continued to say if the strait is closed by April, Japan's literally nobody's driving, and that hasn't happened. And they just keep saying if it closed by, and it's always a couple weeks from today. So again, at some point, yeah, it could, but the global economy, the machine, it's rerouted resources, and people seem to be getting the crude they need and the gasoline they need and the jet fuel they need, etc. So you
yeah,
just have
it's
to
a
you have to
yeah,
be
that's
careful listening to the really exciting headlines.
Well, yeah, that's a good point, and it also just shows how, flexible supply is. So while you've seen it basically shut out of Iran and the Strait of Hormuz, back to mentioning Brazil, you've seen countries like Brazil which have stepped in and are now just exporting a tremendous amount of oil. So there are kind of winners and losers to this, but I think as we've been saying, it's been pretty much indiscriminately not negative for all markets. I mean, you take Korea, for example, which is a huge importer of oil, on
Specifically from the Middle East, right? They're a big
exactly.
importer of oil from the Middle East, and their stock market's rebounded.
Yeah, so the market's currently looking through it, and that's a function of the fact that, market believes it will pass, which there is supply that will come back on, but at the same time, it also just shows that, there's the ability to get oil from new and different places, I think, is clearly on display.
And the counter is, if it's withstood this, what happens when the strait is opened? I mean,
Yeah.
what happens to the price of oil? I mean, it could, it was trading in a pretty low level historically. It could go, I mean, it could go even lower if all this new supplies come online. So, last chart looks at gold. Again, thank you, Justin. Some more artwork. Horizontal lines. We've been taught that horizontal lines are important in the price of gold here after going into the stratosphere, going down, is back settling around this same level, which happens to be the previous high from before this last one. So
Yeah, this is a pretty classic chart here. Assuming price holds in, this would be a pullback to what was prior highs, but now support. And recently, in this risk off with inflation going up, you've had about all of the traditional headwinds emerge all at once for gold, right? You've had the expectation for interest rates, policy rates go up. You've had long end rates actually go up. You've had a bit of strength to the dollar globally, in particular against currencies like the yen, et cetera. And then you've also had a situation where there's been risk off, at least there was temporarily. And if gold were to hold in here, it kind of would maybe indicate that we are in a secular bull market in gold, and we might get back to the narrative of higher deficits and so on, global central bank diversification, and gold once again could start to get some mojo to the upside.
that was just chart overload. We appreciate you tuning in. Check us out at Sollinda.com or SollindaWealth.com. If you have any questions, you can reach out to us, info@Sollinda.com, info@Solinda.com. Again, we appreciate you spending some time with us, and we'll be back in a couple weeks.